Hey guys, I hope you are doing well. Welcome to this ACCA Financial Management Revision session. My name is Luqman Rafiq and I have been in teaching profession for more than 13 years now. In today's session, I would try to make sure that I take you people through the entire financial management course revision. The major objective is going to be that I touch each and every important area along with the other areas which may form part and parcel of some MCQs, some OTQs. So I'm actually going to take you through the whole of the financial management course. First of all, let's just start off. The first thing that I'm actually going to take you people through is the topic of investment appraisal. So when we talk about the investment appraisal, let's have a quick discussion that with respect to the investment appraisal, what is an investment appraisal all about? So when I talk about investment appraisal is simply as an entity whenever you are up to any capital expenditure project. So you actually make a decision whether we should go ahead with this capital expenditure project or we should not go ahead with that capital expenditure project. So investment appraisal is a technique where we actually decide whether we should invest, whether we should undertake this capital expenditure project or not. So when we talk about the investment appraisal, there are two different type of techniques that are part and parcel of the syllabus. And what are those? One of them is called the profit-based technique and the other one of them is termed as cash flow based technique. So what exactly is the difference between this profit-based technique and what exactly is the difference between this cash flow based technique? Let me just take you through. Amongst the profit-based technique that are part and parcel of your course is the accounting rate of return technique. And when it comes to the cash flow based techniques, the different techniques that are part and parcel of your course are the payback and plus this discounted payback. Then you have got the NPV, the net present value technique, and then you have got what? You've got the internal rate of return technique also. So there are these different type of techniques that are part and parcel of the syllabus. Now let's just start discussing what these techniques are and how do we actually decide on the basis of these techniques whether we should go ahead with our capital expenditure project or whether we should not go ahead with it. So the first thing that happens with respect to the accounting rate of return. The accounting rate of return is also at times referred to as the return on capital employed. So at times you would actually find the examiner asking you about the return on capital employed instead of the accounting rate of return. How do we go about with the accounting rate of return? How do we go about with the return on capital employed? Let's discuss about it. The accounting rate of return is calculated like this. When you say ARR, the accounting rate of return, it is actually determined like this. It says average annual profit. It says average annual profit divided by the investment. Now, what actually happens is that there are two different type of variants for this specific formula. At times the examiner, he makes it very clear to you people whether he wants you to use the investment as a denominator or whether he wants you to use the average investment as a denominator. So you can have both type of things, which is it could actually be an investment being shown in the denominator or it could actually be the average investment being shown in the denominator. Now let's talk that how do we actually go about calculating all of these things. So when I talk about the calculation of average annual profit. So what is this average annual profit going to be? So for example, if you are making an investment in a machine or anything, let's say if your investment has a life, of 5 years. So if your investment has a life of 5 years, so what are you actually going to do? You're going to calculate year 1, year 2, year 3, year 4, year 5. You're going to calculate the 5 years profit. Let's say you're going to calculate the 5 years profit. What exactly are these 5 years profit going to be? Let's say if you've got a profit for the year 1 to be, let's say 100,000. And let's say the year 2 profit is 30,000 loss. The year 3 is you have got 70,000 profit. Year 4 you have got 30,000 profit. Year 5 you have got 200,000 profit. So what are you actually going to do? You're going to say that in order to calculate the average annual profit, what we need to do is that we need to sum up all of them. We need to sum up all of them. How do we sum up all of them? You would say 100,000 positive, 30,000 negative, 70,000 positive, 30,000 positive, and then 200,000 positive. So resultingly, what are you going to get? You're going to say 100,000 minus 30,000 plus 70,000 plus 30,000 plus 200,000. And this is all going to be divided by 5. This is all going to be divided by 5. So when you're going to divide all of this by 5, so you would resultingly get the average annual profit. What are you going to get? You're going to get average annual profit. So I think it turns out to be approximately 74,000. 74,000 is your average annual profit. Now, what are you going to do? You're going to divide this average annual profit with the investment. Now, when we talk about the investment, let's say you had an investment of 1 million. So one of the things is that the examiner could actually ask you for the accounting rate of return based on the investment. So if you're going to talk about the accounting rate of return on the basis of investment, so this is 74,000 divided by 1 million. I repeat, this is actually going to be 74,000 divided by 1 million. So you would actually have what? You would actually have 7.4% as a return. Or alternatively, the examiner could ask you about the average investment. And when he is going to ask you about the average investment, what are you going to do with respect to average investment? You are going to say, if we are going to talk about the average investment, it's going to be the opening investment plus closing investment divided by 2. So what is it going to be? The opening investment plus the closing investment divided by 2. So let's say you had an opening investment of 1 million plus you have a residual value of, let's say, 200,000. So what are you going to do? You're going to say opening investment of 1 million plus the closing investment of 200,000 divided by 2. So resultingly, what are we going to get? We're going to get 600,000 as the average investment. What are we going to get? We're going to get 600,000 as the average investment. So you as a student could be asked by the examiner to calculate the accounting rate of return, and he could use both of them. What he could use? He could use the normal investment as a denominator, or he could use the average investment as a denominator. Now, so the examiner would not just ask you to calculate the accounting rate of return, but he would also ask for the decision making that should we invest in this project or should we not invest in this project. So how exactly are you going to decide if we should invest in this project or if we should not invest in this project? So he would actually say that as an entity, we have got a target return on capital employed of, let's say, 11%, of let's say 12%, whatsoever that is. So all that you have to do is that you have to compare the project's ARR versus the target return on capital employed. I repeat, what is it that you need to do? You need to compare the accounting rate of return with the target return on capital employed. So when you're going to compare the accounting rate of return with the target return on capital employed, what is ultimately going to happen is that you will get an answer. So if, like, for example, the target return on capital employed is, let's say, 11% and the project has a ARR of 12%, you will invest in the project. If the accounting rate of return is 10% versus the 11%, what are you going to do? You're not going to invest in the project. Why? Because it is not making sense to invest in this specific project for you as an entity. Now let's move a bit forward and let's discuss a bit further. The next aspect of this question, the next aspect of the investment appraisal is to talk about the cash flow based technique. So I repeat, when we talk about the cash flow based technique, the cash flow based technique could actually be based on undiscounted cash flows. It could be based on discounted cash flows. So the cash flow based techniques could be based on undiscounted cash flows. They could be based on discounted cash flows. When we talk about the undiscounted cash flows, there is only one technique, which is called the payback period technique. And when we have got discounted cash flows, there are three techniques, which is, one of them is called discounted payback. The other one of them is termed as discounted payback. The other one of them is the NPV, and the third one of them is the IRR. Now, If I talk about, before getting into this discounted, undiscounted, if I talk about the concept of cash flows that are used, so always remember, in order to do the cash flow based calculation, it's the relevant cash flows that we use. I repeat, it's the relevant cash flows that we use. Now, what do we mean by relevant cash flows? So when we talk about the relevant cash flows, the concept of relevant cash flows is that they are the cash flows that arise because of this specific investment decision of whether we should invest in the project, whether we should undertake this capital expenditure, or whether we should not undertake this capital expenditure. So if I talk about the relevant cash flows, the relevant cash flows have got certain attributes, have got certain characteristics. The relevant cash flows are incremental, that is, they are differential cash flows. For example, if you as an entity are having a sale of 100,000, and because of undertaking the project your sales become 140,000, so the 40,000 is going to be considered as incremental. Then you have got what in addition to the incremental, they are directly attributable. What do you mean by directly attributable? The directly attributable means they are arising because of a specific decision. So if you are taking a decision to invest in a project, invest in a capital asset, so ultimately that's going to be considered as directly attributable, like the machines that you purchase, the materials that you purchase, the labor costs that you incur, they're all going to be considered as the directly attributable cash flows. The third one of them is called the opportunity cost. The third one of them is called the opportunity cost. Now when we talk about the concept of opportunity cost, the opportunity cost is going to be considered as the benefit loss because of. I repeat, the opportunity cost is going to be considered as the benefit loss because of undertaking a decision. So like for example, you have got a premises which you own, but you have rented it out to a third party. Now you want to start off, you want to set up a plant in that specific premises. You ask the tenant to vacate the premises. So whatever the rental income that you are going to be losing, that's going to be opportunity cost, and it's going to be relevant for your project. So the relevant cash flows, they are what? They are incremental, they are directly attributable, and they are opportunity cost. Now similarly what happens is that what are going to be considered as irrelevant cash flow. So we also need to know that what are going to be considered as irrelevant cash flows. So irrelevant cash flows are the past costs, that is the costs that have been incurred in the past. They are also termed as sunk costs. They are called committed costs, the costs which have already been committed, which are not arising because of this specific decision. Like for example, if you as an entity, I repeat, what is called the committed cost? Committed cost is the costs that have been committed in the past. Like, let me just guide you a bit. For example, if you are an entity, and being an entity, you have employees whom you have to pay the salary irrespective of you undertake this capital expenditure or not. So that is actually a committed cost. If you have a premises for which you have to pay the rent irrespective of you undertake the new capital expenditure or not, so the rentals that you have to pay, that's a committed cost. So you have got past cost, you have got committed cost. Now similarly, the allocated cost. Let me just guide you the allocated cost. Like for example, a lot of things, what happens is that we allocate. Like we are incurring the electricity already. So just because there is a separate project that's being undertaken, so the existing electricity is being allocated to that project also. Like because what happens in a lot of organizations is that they do the allocation on the basis of floor area. So if they do the allocation on the basis of floor area, so doing the allocation on the basis of floor area would actually mean that what you are allocating the existing cost to that. That's not a cost which is arising because of the investment decision. So ultimately it is going to be considered as irrelevant cost and will not be considered for your cash flow calculations. So we have discussed that when you are going to be using the cash flows are going to be the relevant cash flows. Now, the payback period technique needs to be discussed. That what is a payback period technique? So, what is a payback? Payback period is simply the time taken to recover the investment. Time taken to recover the investment. Because a lot of people, what they do is that when they make an investment, They make an investment with an objective that I want my investment to be recovered in 3 years. I want my investment to be recovered in 4 years. That's how people make investment. So I repeat, as an entity, when you make an investment with multiple objectives and multiple targets. Like I want my investment to be recovered in 3 years. I want my investment to be recovered in 5 years. I want my investment to be recovered in 4 years. That's how you set out the target. So if you have got a target to recover the investment in a certain period of time, and if that target is being met, so what you do is that you invest in that project. So like for example, you target that I want my investments to be recovered in 4 years. And now what actually happens is that, let's say if your project is giving you a payback period of 3.5 years. I repeat, if that project is giving you a payback of 3.5 years, so 3.5 years of payback would actually mean what? 3.5 years of payback would mean that you're meeting the target of 4 years recovery. Now, how do we actually calculate the payback period? So there are basically two types of situation. One of them is when you get the constant cash flows. What do you mean by constant cash flows? When you've got the cash flows which is arising like this, like each year you're getting 100,000, each year you're getting 200,000. So simple, all that you have to do is that you have to simply say the investment amount divided by annual cash flow. Divide by annual cash flow. So resultingly, what are you going to get? You will end up getting the payback. So like let's say if you have got a $1 million investment and the annual cash flow is 250,000, so resultingly 4 years is going to be your payback. It could also be like this, that you've got 1 million as the investment and maybe your annual cash flows are 300,000. So if your annual cash flows are going to be 300,000, so you would get 3.33 years. I repeat, you would get 3.33 years as your payback period. So if you're going to get 3.33 years as your payback period, so resultingly it's going to be 3 year and 0.33 year could be converted in terms of months, in terms of years, in terms of weeks. It could actually be like this. So like maybe what you could do is that you could say 3 year and 0.33 year multiplied by 12. So it could actually say 3 year 4 months. Or the examiner could ask you the question in terms of number of months. So you could directly say 3.33 into 12. Or he could ask in terms of weeks, in which case you could multiply it with 52 and so on and so forth. Is that okay to you people? Now, so what I have done is that I have also gone through the concept of payback where we have got the constant cash flows. Now, let's talk about the payback period when you have got variable cash flows. When you have got a variable cash flows, like for example, I've say here, I would say there is this cash flows. Now let's say at time period 0, you make an investment of 500,000 in a project. You make an investment of 500,000. Now what happens in year 1, year 2, year 3, year 4, you've got the cash flows in different time periods. Let's say you got 140,000 here. Let's say you have got 300,000 here. Let's say you have got 60,000 here in year 3. You have got 150,000 in year 4. Now, let me just guide you a bit. Okay, you've got 120,000 in, you've got 180,000 in year 3. Now, what happens is that the cash flows that are arising out of each year, they are not constant cash flows, they are variable cash flows. They're increasing some year, they're decreasing some year. So it's not a constant cash flow, it's a variable cash flows. So what are you going to do? You're going to make another column over here, and that column is going to be for the cumulative cash flows. I repeat, that column is going to be cumulative cash flows. Now, what's going to happen? It's going to be 500,000 at time period 0. And when at time period 1, you've got 140,000. So negative 500 plus 140 actually gives you 360,000 as a cumulative outflow. Why? Because this plus this gives you negative 360,000. Now what you do is that you add up these two, so you would get a cumulative negative 60,000, and when you add up all these, you end up getting a positive cumulative cash flow of 120,000. Now what does it tell us? It tells us that your payback period lies somewhere in between this year 2 and year 3. So if you are going to be calculating the payback, How are we going to be calculating the payback? We would say it's 2-year plus. Plus, how much is the outstanding cash flow? It's 60,000 is the outstanding cash flow that is to be recovered at the end of year 2 divided by 180,000, which is the year 3 cash flow that's going to arise. So resultingly, you would have what? You would have 2.33 years. I repeat, you would have 2.33 years, right? So now you can convert this into months, you can convert this into years and months. But this is something that you would have to remember, that if you have got a payback period calculation where you have got variable cash flows, so this is how you're going to do. You calculate, you're going to create a cumulative cash flow column, and on the basis of cumulative cash flows, you're going to work out. Now let's move a bit forward and let's discuss further. The next aspect of the question, the next aspect of the technique is the discounted cash flows. So next aspect is the discounted cash flows. That what are the discounted cash flows? You know this thing, that when we talk about the discounted cash flows, it's actually incorporating the effect of time value of money. I repeat, when we talk about the discounted cash flows is incorporating the effect of time value of money. How do we incorporate the effect of time value of money? I'll give you a bit of an idea. So like generally what happens is that when we have got discounted cash flows, when we have discounted cash flows, the discounted cash flows operate like this. You have to calculate the present value of cash flows. So how do we calculate the present value of cash flows? The present value of cash flows is simply the expected cash flow multiplied by discount factor. Whatever the expected cash flow is, that cash flow is going to be multiplied with the discount factor. So now when we talk about the cash flow multiplied by the discount factor, what are going to be the discount factor? There are majorly 3 different types of discount factor, and let me guide you. You are being given the tables for the discount factors in the exam, and these 3 discount factors are what? These 3 discount factors are called present value factor, they are called annuity factor, and they are called perpetuity factor. So there is this present value factor, there is this annuity factor, and there is this perpetuity factor. So when do we use the present value factor? We use the present value factors whenever there are variable cash flows. Like you have got cash flow different in year 1, 2, 3, 4, so on and so forth. You use the annuity factor when you have got constant cash flows. When every year there is a constant cash flow, you use the annuity factor. When do we use the perpetuity factor? We use the perpetuity factor when we have got the cash flows which arise up till infinity. We use it when the cash flows arise up till infinity. Now, what is the formula for the present value factor? It is 1 plus r power minus n, where r is the interest rate and n is the time period, and n is the time period. Then you have got constant cash flows. How do we calculate the constant cash flow? It's 1 minus 1 plus r power minus n divided by r. How is it? It's basically 1 minus 1 plus r power minus n divided by r. That's what the annuity factor is all about. And then we have got the perpetuity factor, which is calculated like this: 1 upon r. 1 upon r. Now, so let me just guide you a bit. Basically, you have got present value factor, you have got annuity factor, you have got the perpetuity factor. So all that you have to do is that you have to multiply the cash flows with the relevant discount factor depending upon the type of cash flow it's there. Let's move a bit forward and let's discuss further. First of all, if I have got a situation where I need to calculate the discounted payback, so what am I going to do? I'm going to use the same technique as I use for the payback period. The only difference that's going to arise is that instead of using the normal cash flows, I shall now be using the discounted cash flows. I shall now be using the present value of the cash flows. So like let me just give you a bit of a guidance about it. It's going to be here, cash flow, discount factor, present value, and then you would have one more column, and that's actually going to be cumulative present value, right? Now what is actually going to happen is that whatever time period 0, let's say 1 million is an outflow, whatever the discount factor is 10%, let's say, you would say this is going to be 1 million. You would have 1 million as the cumulative present value. Now at time period 1, if it is let's say 100,000 only, so you'd say 1.1 power minus 1, the present value might become 90901. So whatever you are going to do, you're going to calculate the cumulative present value on the basis of this negative 1 million plus this 90901, and it will go on and on and on and on, and ultimately you would establish the payback on the same manner, in the same manner, just like we did the calculation for the normal payback when we had a variable cash flows. So this is how you're going to do the calculation for the discounted payback. Now one thing that I want you to remember with respect to discounted payback is that irrespective of, I repeat, irrespective of whether you have got constant cash flows, whether you've got variable cash flows, for the discounted payback you would have to create a table like this. Why? Because you are not using the cash flows, you are rather using the present value of the cash flows. That's what you would have to use. Now let's move a bit forward, let's discuss a bit further. What next is there? We have talked about the discounted payback also. Now we are going to talk about the net present value, which is the NPV. Net present value, which is the NPV. What exactly is this NPV? So in simple terms, the NPV is the present value of inflows minus the present value of outflows. Let me just guide you. There are shortcuts which can be used on the Excel and on the spreadsheet which is given in the examination. I've created a video on this specific thing which I'm going to give you a link of. So you could find somewhere at the top of this video right now the link to the video which gives you guidance about how to use the ACCA CBE practice platform. Now with respect to the NPV calculations, there are a few things which you need to keep in mind. Obviously there is a format which needs to be followed. So I'm going to take you people through the format which needs to be followed. So generally speaking, what happens is that whenever we have got the NPV calculation, we would go about like this. We would say time period 0, time period 1, time period 2, time period 3, so on and so forth. So generally you would say sales, variable cost, contribution, fixed cost, depreciation. There are different methods of dealing with the depreciation. I'm going to give you guidance of all of them. Then you've got profit before tax. Then you've got the tax. And then what you do is that you add back depreciation. After adding back the depreciation, what happens is whatever the investment that you do, then there is this working capital. At the end, you have got cash flows, the discount factor, and then what happens is that you get present value, and the sum of all these present value would give you NPV. The sum of all these present value is going to give you NPV, the net present value. Now let's start discussing about it. What is actually going to happen, let's say. So you have got a starting point is the sales, where you start off with the sales being an inflow. You have got whatever the variable costs are there, you deduct those variable costs. As a result of this, you get the contribution. After the contribution, what happens is that you deduct all the fixed costs, you deduct the depreciation, and then you have the profit before tax. Once you have the profit before tax, so with the profit before tax, what you do is that you deduct the tax from it, and then what happens is that you add back the depreciation. Now, if I say you have to add back the depreciation, I'm going to guide you that there are multiple ways of dealing with it, there are multiple ways of handling it. Now, when I said that it's basically either deducting the depreciation, then adding it back, and then you've got an investment, the outflow, then you've got the, okay, it has to be a positive one, like it's a residual value that's coming out, and then you've got the working capital, which is usually outflow, and then at the final time period, it's an inflow. Now let me just guide you that how are we going to do it. Whatever the depreciation that you deduct over here, you add back the same depreciation. Why? Because we want to have the profit before tax. This is the profit on which tax authorities are going to apply the taxation. So we need to deduct the depreciation that's allowed by the tax authorities, and then we need to add it back. Now, let me just guide you a bit with respect to depreciation and its related things. Basically, what happens is that there are two ways of dealing with the depreciation. Let's say you have got profit before tax and depreciation to be 1 million, let's say. Then you have got depreciation of, let's say, 300,000. So you have got profit before tax of 700,000. Now what actually happens is that there's going to be a tax, let's say if there is a tax of 30%. So you have 210,000 being the tax which needs to be deducted. And then you would add back this depreciation which was deducted above, because it's a non-cash item. So resultingly what's going to happen is 700 plus 300 minus 210 gives you 790,000. What is it going to give you? It's going to give you 790,000. Now there is an alternate way of doing it, which is you have got profit before tax and depreciation, which is 1 million. You directly apply tax on it at the rate of 30%. I repeat, what you do is that you directly apply tax on it at the rate of 30%. So when you're going to apply tax on it at the rate of 30%, it's going to be 300,000 directly. Now what happens is that you would say tax savings due to depreciation. Which is actually going to be what? You have got 300,000 as a depreciation, 30% to it. 300,000 into 30% gives you 90,000. Needs to be added back. And then resultingly what happens is 1 million minus 300 plus 90. 1 million minus 300 plus 90, again you're going to be standing at 790,000. So these are both ways of doing the depreciation calculation. Either you deduct the depreciation, calculate the tax, then add back the depreciation. Or alternatively, what you could do is that you could simply, you could do is that you could just go about deducting the tax directly from the profit without the depreciation, and then you add back the tax saving due to depreciation. That's how you do it. Now there is one more aspect which is about the taxation. The examiner could actually give you multiple scenarios with respect to tax. He could say that tax is applicable in the same year. So if year 1 profit, you will have tax in the same year. If the year 2 profit, you will have the tax in the same year, right? So you will have the tax in the same year, year 1, year 2. The examiner could actually give you a situation where he could say the tax is paid in arrears. Now what do you mean by this? This is 1, this is 2. So you have got profit, and now what happens is that the tax on the year 1 profit is going to be shown in the year 2. The tax on the year 2 profit is going to be shown in year 3. So he could tell tax in arrear, he could say tax in the same year. It could even be half of the tax given in the same year, half of the tax given in arrear. So like you could go about doing both of the things, like half tax here, half tax in the next year. It could also be the case. Then when we have got the working capital changes, so let me just give you a bit of an idea about how working capital changes are going to operate. So generally speaking, the examiner, he would have given you that what are going to be the working capital requirement for each of the year. It could be as a percentage of sale, it could be as a X amount, it could be anything. It could be growing by the rate of inflation. There could be multiple types of things. So like for example, in the year 1, he might say we need 100,000. In the year 2, we need 150,000. In the year 3, we need 220,000. In the year 4, maybe he could say in year 4, we need 170,000. And the year 5, we need 200,000. Maybe he could say these things. Now what actually happens is that from the perspective of the exam, you would calculate incremental working capital. I bet you are going to calculate incremental working capital. So incremental working capital is going to be 100,000. Then incremental working capital is going to be 50,000. It's the difference between these two. Then incremental working capital is going to be 70,000. Then incremental working capital is going to be recovery of 50,000. Then incremental working capital is going to be 30,000. Now what are you actually going to do? You're going to show this incremental working capital as an outflow at time period 0. You would show it as an outflow. Why? Because working capital is applied at the start of the year. And for year 1 start, you need the capital to be applied at time period 0, which is now. This additional amount is going to be applicable at time period 1, this one at time period 2, and this is actually going to be recovery because the working capital is not required that much as it was needed earlier at time period 3. This much amount of 30,000 is going to be shown as an outflow at time period 4, and then at time period 5, we would have the entire 200,000 being recovered. We would have 200,000 entire being recovered. Why? Because it's not needed anymore. The capital is not needed. The money is not needed anymore. So you're going to recover the entire 50,000, 200,000. That's how you're going to talk about the working capital. You could have year, you could have working capital, you could have incremental working capital also. This is what it is going to be. So your incremental working capital is going to be shown like this in the net present value calculations. Now, there are a few more aspects with respect to the NPV which I think you should know, and that's basically use of inflation. the examiner and use of inflation and the interest. Now first of all, the interest expense, you should never ever show the interest as an outflow. You should never show the financing cost as an outflow in the NPV calculations. Why? Because we are already discounting the cash flows. So when we are discounting the cash flows, the interest cost, the effect of interest is already incorporated in the discount rate. Now, the discount rates, you can get two type of discount rates. You can get real rate, you can get nominal rate. Now what is this real rate? The real rate is without inflation. The nominal rate is inflation adjusted. The nominal rate is inflation adjusted. Now the connection between the real rate and the nominal rate is through a formula for the Fisher's effect, which is 1 plus m is equivalent to 1 plus r multiplied by 1 plus I. Now what is this formula all about? The m is the money rate of return, which is also called the nominal rate. The r is the real rate, which is without inflation. I is the inflation. I repeat, I is the inflation. Now, so what happens is you have got money rate of return, you've got real rate of return, you've got inflation rate. Now, there are different type of discount rates which need to be, which are available. So when do we use the real rate? We use the real rate when we have got the real cash flows. When do we use nominal rate? When we have got nominal cash flow. As the name suggests, the real cash flows are without inflation. The nominal cash flows are inflation adjusted cash flows. Now, there is one more thing that I want you people to understand, and what is that going to be? Let's try to understand this. Basically, the real cash flows, how do you identify in the exam that the examiner has given real cash flows that is without inflation? So he could also say the cash flows are expressed in current terms, current price terms. So that is also an implication that it's a real cash flow. The examiner could also say that the nominal cash flows, there is also another explanation, which is the cash flows are expressed in money terms. So when the examiner says that the cash flows are expressed in money terms, the money terms are also an indicator that ultimately it's without inflation. Now this is how you actually incorporate all the concepts into the NPV calculation. Now let's move a bit forward and let's talk about the IRR. So when we talk about IRR, we know the internal rate of return is the discount rate at which NPV is 0. So IRR is the discount rate at which NPV is 0. Before I move on to IRR, for the NPV, I hope you people know that the decision making is done on this basis that if the NPV is positive or 0, we invest. If the NPV is negative, we reject them. So IRR is the discount rate at which NPV is 0. IRR is calculated using the formula A% plus capital A divided by capital A minus capital B multiplied by B% minus A%. Where what actually happens is that you have got A% as the lower percentage, capital A is the NPV at A%. You have got B% as the higher percentage, and capital B is the NPV at B%. Now what actually happens is that from the perspective of the exam, what I would suggest is that you use the IRR function, which is simple. You're going to use the IRR function, you're going to open up the bracket, you're going to select all the cash flows, and you're going to apply a comma to it, and you would give a general guess. Maybe it could be 10%, 12%, whatsoever, and you would end up getting the IRR. So from the perspective of the exam, you don't have to do the long calculation of one discount rate, another discount rate. No. All that you have to do is that equals to IRR function, simple all the cash flows, and you'll get the IRR. Here again, I'm giving you a video link in the in a simple balloon over here or something, which is going to give you an idea that how to use the IRR in the CB practice platform. So basically, this is all about the general concept of the investment appraisal. There are specific decisions which we are now going to discuss a bit later, but right now I just concluded the entire concept of the NPV of the investment appraisal. Okay, we are now going to move forward and discuss further aspects of the investment appraisal. Now, the first thing that I'm actually going to be discussing about some specific investment decisions that are required to be made. So one of the decisions that actually does arise is lease or buy decision. So when you are purchasing an asset, there is obviously an option to lease it instead of purchasing it outright. Why to invest $5 million into purchasing an asset rather than paying, let's say, $300,000 every year for the use of the asset? So obviously, as an entity, you have a decision to make. Now again, what happens is the comparison is going to be made on the basis of relevant cash flow. So if I say, let's say, when we buy an asset or when we lease an asset, so resultingly the sales are going to go unaffected, the variable costs are going to go unaffected, but the asset related costs are going to be affected. So basically the decision is going to be on the basis of asset related cost, not on the basis of sale, not on the basis of variable cost, but on the basis of asset related cost. Let me just guide you, let me take you through. So if you buy the asset, what happens is that one of the costs is the cost of the asset as an outflow. Then you have got residual value of the asset, which is an inflow. Then you have got tax savings on depreciation. Furthermore, you have got repair and maintenance. Then what else did you have? You have got the repair and maintenance. Then what else do you have? You have got, in addition to this repair and maintenance, you have got the tax savings. You have got the tax savings on repair and maintenance. So I repeat, when we talk about the buying of an asset, so these are generally the cash flows that actually arise. What are the cash flows that arise? You need to have the cost as an outflow. You need to have the repair and maintenance as an outflow. The rest, the residual value, the tax savings on depreciation, the tax savings on repair and maintenance, they are all inflows. Similarly, when we have got an asset which is obtained on the lease, so what happens is that the lease rentals are an outflow. The tax savings on the lease rentals are an inflow. Plus there could be other types of inflows and outflows. Now what actually happens is that you have the net cash flows here. You have got the net cash flows here. Now what happens is that you convert the cash flows into present value. You convert these cash flows into the present value. So when you have converted these cash flows into the present value, what do you need to do? You need to just compare the present value. I repeat, you just need to compare the present value of both of them, for the buying option, for the leasing option. And when you're going to compare the buying and the leasing option, resultingly, whichever is going to be the cheaper option, you will go for it. So like for example, if it turns out to be 300 or 3 million as an outflow, if it comes to the buying option, and if it comes to 2,875, 700, so obviously you are going to go for what? You're going to go for this specific option, which is going to be the leasing option. I repeat, you're going to go for this option, which is going to be the leasing option. Now let's move a bit forward. Let's discuss a bit further. So I've actually talked about one of these specific decisions, which is about lease or buy. So from the investment appraisal, one of the decisions that you have to make is whether you are going to lease the asset or you're going to buy it outright. Then what actually happens is that we move on to the next aspect. There is this asset replacement cycle. What is the asset replacement cycle? So asset replacement cycle is you have the assets which are being used regularly in the business. and they need to be replaced, because you know this thing, just like you can take an example of a car. If you have got an old car, I repeat, if you have got an old car, so what happens with respect to the old car is the older it gets, the higher the repair and maintenance cost keeps on rising. The older it gets, the residual value keeps on declining. So as an entity, you have to decide that what should be your replacement cycle, whether it should be that you should replace your old asset with a new asset every year, or whether you should do it every 2 years, or whether you should do it every 3 years, or whether you should do it every 4 years, depending upon that what is going to be feasible for you as an entity. You decide upon an appropriate asset replacement cycle. So I repeat, the asset replacement cycle, the appropriate asset replacement cycle could be 1 year, 2 year, 3 year, 4 year, 5 year, whatsoever that is. Now how exactly are we going to talk about this asset replacement cycle? So you see, the cash flows for 1 year cannot be compared with the cash flow for 2 year, 3 year, or 4 year. So in order to make sure that these cash flows become comparable, we calculate one thing which is called equivalent annual cost. The formula for the equivalent annual cost is not given in the examination, so you would have to memorize it, you would have to remember it. What is the economic equivalent annual cost? It's the present value of cash flows divided by annuity factor. You've got present value of cash flows divided by the annuity factor. That's how you get the equivalent annual cost. Now, what is the present value of the cash flows that we would have to use? So generally speaking, what happens is that you would create 1 year replacement cycle, and how the cash flows are going to be, usually time period 0, time period 1. That's how the cash flow cycles are going to be. What is it going to be? Let's say there's going to be repair and maintenance, there's going to be tax savings on repair and maintenance, there's going to be investment, there's going to be residual value, things like that. And then you would convert this into present value. So you would do one calculation for the 1 year cycle, you would do a similar calculation for a 2 year cycle, you would do a similar calculation for a 3 year cycle, etc., etc. The difference between 1 year, 2 year, 3 year cycle is going to be the timing of residual value, the amount of the repair and maintenance expenditure, and obviously the tax savings associated with it. So what are you going to do? You're going to calculate all of them, you're going to calculate their present values, and those present values are going to be compared with the annuity factor. Like for the 2 year, it has to be 2 year annuity factor, for 3 year it has to be 3 year annuity factor, for 4 year it has to be 4 year annuity factor, so on and so forth. That is how things are going to be. Now, so equivalent annual cost, which is going to be the cost on an annual basis, the present value of the cost on an annual basis, that's what the equivalent annual cost is going to be. Now, obviously, whichever the lower equivalent annual cost is going to be, you would opt for it. 2 year, 3 year, 1 year, depending upon whichever replacement cycle gives you the lower cost, you will actually go for it. Let's move a bit forward. Let's have a bit more discussion. Now, what next is there? The next is, we have got one more aspect, which is the capital rationing. Now, what is this capital rationing all about? So there are different types of capital rationing. The capital rationing could be soft. The capital rationing could be hard. Now, what is this soft capital rationing? What is this hard capital rationing? So when the capital rationing is that when you have got limited capital and you have got many investment opportunities. So you cannot invest that capital into every single opportunity that you get. So basically what you need to do is that you need to invest in a project that is going to be appropriate, that is going to be relevant for you as an entity. So when I talk about capital rationing, the soft capital rationing is internally imposed restrictions. So when you as an entity have an internally imposed restrictions, that is going to be called soft capital rationing. Like maybe as an entity you don't want to obtain loan, maybe as an entity you don't want to invest in the further projects, maybe you don't want to make further issuance of the equity. That's internally imposed restriction, and that are basically the softer elements. They could be you could go for the leniency of them, you could actually relieve those restrictions, things like that could happen. When it comes to hard capital rationing, what happens with the hard capital rationing? The hard capital rationing is that what generally happens is that we have got restrictions which are imposed externally. Like the environment is such, you cannot raise money. Environment is such, you cannot raise capital. That's called hard capital rationing. Now, let's move a bit forward. Let's discuss further. Basically, the capital rationing are of two types. One of them is, first of all, you need to understand at the FM level, the capital rationing is only single period capital rationing that is examinable. Single period capital rationing means if there is a life of 4 year, 5 year of the project, you're only facing the limited capital issue at time period 0. You're not facing this issue at time period 1, 2, 3. That's an AFM agenda, that's an AFM topic that you have got multi-period capital rationing. Now, basically what happens is that the single period capital rationing, the projects could be of two types. What are those two types of project? One of them is a divisible project, the other one of them is an indivisible project. What's a divisible project? What's an indivisible project? Let me just guide you a bit. When I talk about a divisible project, that concept of divisible project is a project that can be scaled down. What you could say is that you could say part of project can be undertaken. Like for example, you want to install a power plant, and if the power plant is of 100 megawatts and you say I don't have the capital available, I only have the capital available to install a smaller plant. Is it possible? Yes. You can get a 20 megawatt, you can get a 30 megawatt, you can get a 40 megawatt, you can get a 60 megawatt, so on and so forth. So if you can have power plants installed of a smaller capacity also, so we would say that this capital expenditure project is a divisible project. What is it? It's a divisible project. Then you have got indivisible project. The indivisible project actually means that only a complete project could be undertaken. So like for example, if there is a 100 megawatt, you cannot undertake 30 megawatt project. It has to be 100 megawatt, 100 megawatt and 100 megawatt. That's how things are going to be. Now, let's just move a bit forward. So I am telling you that when we talk about the projects, there are divisible projects, there are indivisible. Divisible is part of the project can be undertaken. What is indivisible? Only a complete project could be undertaken. So when you have got divisible project, what you do is that you apply the technique of profitability index. And when you have got an indivisible project, so for the indivisible project, what you do is that you don't apply the technique of this profitability index, but this is actually fixed using trial and error basis. What is it done? It is usually fixed using trial and error basis. So this is usually termed as trial and error basis. Now, what is this profitability index going to be? If I can give you a bit of an idea, the profitability index for any project is NPV divided by investment. The NPV divided by the investment. So what is it actually going to be? It's going to be the NPV divided by the investment. Now let's move a bit forward and let's see that how we actually go about it. So there are certain steps that you need to follow if you are dealing with divisible projects. So I repeat, if you are dealing with divisible projects, there are certain steps that you would have to follow. Now what are those certain steps that you would have to follow? Let's talk about it. The step number one of them is to calculate PI is profitability index of each project. The second step is you have to rank the projects. The third one of them is you have to allocate resources. So like first of all, you calculate profitability index, and obviously the higher profitability index is ranked higher. The lower profitability index is lower, ranked lower. So you calculate profitability index of each project, you rank the projects, and you allocate resources, and then calculate resultant NPV. So like if you have got project A, B, C, D, and if you have got a profitability index of, let's say 0.221, 0.15, 0.221, 0.19. So what are you actually going to do? You're going to rank these projects. You're going to say that this is the first ranked project, this is second ranked project, this is third ranked project, this is fourth ranked project, and you would rank them and you would move accordingly. That's what you are actually going to do. So you would allocate whatever amount that you have to project C first, then remaining to project A, then to project D, and so on and so forth. Now if I move a bit forward and if I discuss further, so when we talk about the concept of, I repeat, when we talk about the concept of indivisible projects, the concept of indivisible projects is that basically what you do is that you allocate the resources, I repeat, you allocate the resources in a manner such that there is a trial and error that you do. Like there is a project A, B, C, D, you need 100,000 for it, you need 200,000 for it, you need 150,000 for it, you need 250,000 for it, let's say. And if you have an available capital of, let's say 320,000, so you would create different type of options. You would say A plus B, you would say A plus C, you would say only B or only D. So wherever you will get the cumulative higher NPV, you would go for that specific type of a project. That's what you're gonna do. So basically this is how the capital rationing situation is handled. Let's move a bit forward and let's talk about the final aspect, that with respect to investment appraisal, there is an area which is to incorporate the risk and uncertainty in the decision making. I repeat, there's an area which is to incorporate the risk and uncertainty with respect to decision making. Now when we talk about the incorporation of the risk and uncertainty in the decision making, so there are different type of techniques. One of them is, first of all, let's talk about the difference between what a risk is, what an uncertainty is. So simply when you can assign probability to an outcome, I repeat, when you can assign probability to an outcome, this is going to be considered as risk. I repeat, when do you face a risk? You face a risk when you can assign a probability to an outcome, that means risk is being faced. When you cannot assign a probability to an outcome, that is, there is going to be 20% risk or 30% risk or so on and so forth. So this is actually going to be considered. This is actually going to be considered as an uncertainty that's being faced. Now, so let me just guide you people a bit. Generally, what happens is that there are different type of techniques, and one of them is the expected value technique. The expected value technique is based on average probability. So like for example, let's say I am saying that a project has an NPV of 100,000, there is a 30% chance for it. A project has an NPV of 150,000, le lo. there is a chance of, let's say, 40% for that. A project has a negative 10,000 NPV, and there is again 30% chance of it. So what happens is that if you have to calculate the expected NPV, you would say 100,000 into 30% plus 150,000 into 40% minus 10,000 into 30%. So then what you are going to do is that you're going to add up all of them. So this is going to be 30,000, this is going to be 60,000, this is going to be 3,000 negative. So resultingly you would have 87,000 as the expected net present value. What are you going to have? You will have the 87,000 as the expected net present value. Now, so this is one of the technique, and there is another technique which is called sensitivity analysis. Now when we talk about the sensitivity analysis, so what is this sensitivity? So the concept of sensitivity is basically how much percentage change in a variable. So how much percentage change in a variable that is going to be required in order to make in order to lead to zero NPV, right? That's going to be considered as sensitivity analysis. So if I talk about sensitivity analysis, let me just guide you people a bit that what is going to happen with respect to sensitivity. All that you have to do is that in order to calculate sensitivity, you would have to say the NPV of the project divided by present value of variable. So like for example, you're getting sales, 2% change in sales will lead to zero NPV. You're getting variable cost 1.3%. You're getting fixed cost as 5%, so on and so forth. So hence on the basis of this, you would say that the smallest change on the variable cost would lead to zero NPV. This is the most sensitive variable, and as an entity we should be concerned about it. As an entity we should focus on it. As an entity we should make sure that we control it. So basically that's what another aspect of investment appraisal is. So we have now concluded the revision of the whole of the investment appraisal, and I hope that you have actually enjoyed it and you have had complete revision of this investment appraisal now. Okay, so we now move on to the next area of the syllabus, and that's actually about the sources of finance. So let me just give you a bit of a guidance about what exactly is the sources of finance. First of all, you need to understand that from the perspective of the financial management examination, this sources of finance could be examined as a theoretical area, and it could also be examined as a computational area also. But now how exactly is this sources of finance examined, and what are the things that we should know with respect to sources of finance? So let me just give you a bit of a guidance. Basically, you know that when we talk about obtaining funds for a business, there are two major sources. And what are those two major sources? You could either go for the debt as a source of finance, or you could go for the equity as a source of finance. Now when we consider debt as a source of finance, we consider equity as a source of finance. So there are multiple factors that we might actually have to consider before we opt for either of the debt or we choose for either of the equity. So there are multiple factors, and what are those multiple factors? The multiple factors that you consider is the cost that is involved, is the availability that is involved, plus at the same time the security that is available for you, that whether you are going to be able to give security to the banks in case if you go for the loans, plus at the same time the credit rating of the entity. So that is also one of the factor. The cost of the source, the cost of the funds, the availability of the funds, the security of the funds, the credit rating of the entity. So these are multiple factors, plus another important factors which is called the concept of dilution of control. Because when you hand over your shares to somebody else, so automatically there is a dilution of control. So again, there are multiple factors. But there is something very important which you need to consider, and in general what happens is that the equity is expensive. In general, equity is expensive and the debt is cheaper. Now, what is the reason that the debt is cheaper and the equity is expensive? So amongst the multiple reasons, one of the reason is that when it comes to, I repeat, amongst the multiple reasons, one of the reason is that when it comes to the debt finance, the risk that is being faced by the debt provider is a low risk. Why? Because they are being guaranteed that they would get their interest, they are being guaranteed that they would get their principal. So there are multiple guarantees that are being given to them. So the debt providers, they get low interest, they get an interest guarantee, they get a guarantee for their principal, so they generally face low risk. Plus at the same time the debt is tax deductible. Now what exactly do you mean by the debt being tax deductible? The concept of debt being tax deductible means the debt, the interest expense is claimable as an expense by the tax authorities. So if you want to claim interest as an expense, the tax authorities would allow you interest as an expense to be claimed. Now, if I move a bit forward, that how is the sources of finance actually examined? So the sources of finance could be examined in a manner that the examiner could actually ask you about the impact of obtaining finance using a certain source on the profit and loss account, impact on your balance sheet, impact on your key ratios, impact on your company valuations, etc., etc., etc. So now let's just talk about that. What is going to be the thing? How is this all going to be having an impact? Let's talk about it. Let's discuss about it. So first of all, what I would do is that I would talk about some of the key ratios that you should know as a student when you are dealing with the sources of finance. You know that we usually, when we have the ratios, amongst the different ratios, there are ratios which could focus upon the gearing of the entity. There are the ratios which are about the ownership, which are about the shareholders ratio. So there are these ratios also. And plus again what happens is that you have got some profitability ratios also, but generally the profitability ratios are usually not examined in this sources of finance a lot. So there is this liquidity ratio, there is the efficiency ratio also, but major ratios that are generally examined in this area are about the gearing ratio and the ownership ratio. So if I talk about the gearing ratio, so the gearing actually refers to the risk, and we have got two types of gearing. One of the gearing is the financial gearing and the other one of them is called operational gearing. What is the difference between both of them? The financial gearing actually relates to the risk relating to finance. The operational gearing actually refers to your business risk. I repeat, the operational gearing actually refers to your business risk. So I repeat, there is a financial gearing, I repeat, there is an operational gearing. What is a financial gearing? What is an operational gearing? The financial gearing is the risk attached with the finance that you have obtained. The operational gearing is the business related gearing. Now, the operational gearing, there is one formula for the operational gearing, which is the contribution divided by PBIT. So let's say if you as an entity have a contribution of 1,000 million and your profit before interest and tax is, let's say, 3,000 million. So you have got 0.33. You have got 0.33. Similarly, if you have got this 1,000 and this is going to be 5,000, so this is going to be 0.20. Now, what actually happens is that the operational gearing actually tells you what? Let me just redo it. It's the opposite of it, which is the PBIT. Contribution upon the PBIT, that's how it is. So if you have got, let's say, contribution of 500,000, PBIT of 200,000. So that means this is 2.5 times. Now similarly, if you have got a contribution of 500,000 and if you have got a PBIT of 100,000, so this is actually going to be 5 times. Now, the greater it is, the more risky the company is. I repeat, the greater it is, the more risky the company is. Because you see, what actually happens is that the difference between this contribution and the PBIT is majorly the fixed cost. The contribution and the difference is majorly the fixed cost. So if you have got, let's say, contribution of 500,000, and if you have got this as 100,000, so that means this is actually 400,000. Now, higher fixed cost is an issue. Similarly, if I could do a comparison, if this is 500,000, if this is 200,000, I repeat, if this is 500,000, this is 200,000. So what actually happens is that, hence, this is going to be 300,000. Let me just guide you. This is going to be 300,000. Now, so you've got contribution less the fixed cost, you end up getting the PBIT. Contribution less the fixed cost, you end up getting the PBIT, the profit before interest and tax. Now, so the higher the fixed cost, the greater the operational risk is. So basically, the higher this ratio is, the riskier the company is. So that's actually about the operational gearing. Now let's talk about the financial gearing. You have got different type of ratios. One of them is called debt to equity ratio. So if I talk about the debt to equity ratio, this is simply debt divided by equity. If I talk about the capital gearing ratio, how do we calculate the capital gearing? So the capital gearing is simply like this. It's debt divided by debt plus equity. Plus, what actually happens is that these actually are the ratios which show you debt as a proportion of total capital, debt as a proportion of the equity. Plus, you have got interest cover ratio, which actually tells you how many times you could pay the interest out of the current profit. So PBIT divided by interest expense, and obviously the higher it is, the less riskier the company is. So let's say if it is 1000 divided by 500, it gives you 2 times. If it is gonna be 1000 divided by 250, it is gonna be 4 times. So the greater the interest cover ratio, the more secured a company is. So ideally speaking, a company should have a higher interest cover ratio. That's how it should actually be. Now let's move a bit forward and let's discuss further. So we have actually gone through these different types of ratios. Now, if I move forward and if I talk about the investor ratio or the owner ratios or the shareholder ratios, so what are the key investor ratios that we should know? So amongst the key investor ratios that are usually examined is, one of them is called earnings per share. The EPS. How do you calculate the EPS? The EPS is calculated as profit after tax divided by number of shares. And this EPS actually tells you that how much earnings have you made on a single share. Then you have got another ratio which is called price earnings ratio, which we also call PE ratio. So the price earnings ratio is the share price divided by EPS. It's the share price divided by EPS, or alternatively you could also calculate it as this. You could say the market capitalization of the company. You could say market capitalization of the company divided by profit after tax, because it could be done on the basis of per share, it could be done on the basis of the total company. Then you have got the third ratio. And what is that third ratio? The third ratio is the dividend cover. So when you talk about the dividend cover, again it's just like interest cover. It's the number of times the dividend could be paid from the existing earnings. So it's profit after tax divided by total dividends. This is for the whole company. Or alternatively what could happen is that you would have this EPS divided by DPS, which is the earning per share divided by dividend per share. That's also one of the ways of calculating it. Then you have got another one which is called dividend yield. Dividend yield is a very important formula for comparing the returns on a share in the form of dividend as compared to the returns that you get on the debt in the form of interest. So like how do we calculate the dividend yield? We actually calculate the dividend yield like this. We say the dividend per share divided by share price. The dividend per share divided by share price multiplied by 100. So you get the dividend yield, which is that how much percentage dividend, how much return in the form of dividend that you are getting by investing in this company. Now there is this last ratio which is a very important ratio, and that's called total shareholder return. What is it called? It is called total shareholder return. Now when we talk about the total shareholder return, what exactly is this total shareholder return, the TSR? Total shareholder return actually refers to how much return you are getting on your shares in the form of dividends, in the form of capital gains, because generally what happens is that dividend plus capital gain is what you get as an investor, as a shareholder, divided by original investment. So whatever the dividends for the year, whatever the capital appreciation for the year, you add up both of them, you divide it by the original investment, multiply by 100. So what do you end up getting? You end up getting total shareholder return. I repeat, what do you end up getting? You end up getting total shareholder return. That's also one of the formulas that actually tells you that how a company is performing. So one of the ways that the examiner would examine the sources of finance is by using these different type of things, which is the total shareholder return, which is the earning per share, dividend yield, dividend cover, etc., etc. Now he could actually ask you what is going to be the impact on them, and obviously in order to calculate the impact, you would have to calculate profit and loss, you would have to calculate the balance sheet items. So this is something that you might have to do. Then let's move a bit forward, and if I talk about the different ways of generating finance. So when we have got the equity, you know the difference between the ordinary shares and the preference shares. Usually what happens is that when we talk about the ordinary and the preference shares, there are multiple differences. What are those multiple differences? One of them is dividend, the other one of them is priority, the third one of them is the voting right. There are multiple other things also, but I'm just talking about the major differences between the ordinary shares and the preference shares. So when I talk about the dividends with respect to the ordinary shares, so you know the dividend are not fixed. These with respect to the preference share, they can be fixed. It's not necessary, but they can be fixed. Similarly, when I talk about the priority, so this is a least priority. I repeat, the ordinary shareholders are the least priority in the case the company gets liquidated, in the case the company gets bankrupt. So it's the least priority share, and they have got priority over ordinary shares. They have got priority over ordinary shares with respect to every distribution, whether that be the dividend, whether that be the distribution upon liquidation, whatsoever that is, they have got the priority. The last thing is that voting rights are there, the voting rights are not there for the preference shares. So the company can go for raising the equity finance using ordinary, can go for raising the finance through preference shares. Generally you go for the preference shares when you don't want to dilute your control, because they don't have the voting rights. They can just be participating, they could just act as a silent partners of the business, but they don't have the voting rights. They are partners but not silent partners, not the active partners, cannot interfere in your decision making, cannot interfere in your day-to-day affairs. These are the things that actually happens with the preference shareholders. Now when we talk about the equity, so there are basically different methods of raising the equity finance. So amongst the different methods of raising the equity finance, one of the method is through the rights issue. And you know what actually happens is that when we talk about the right issue is the issue of shares to existing shareholders. What do? You issue shares to your existing shareholders. That is going to be considered as right issue. I repeat, you issue the shares to your existing shareholders. That is going to be considered as right issue. Now one important aspect with respect to right issue is the computation of the theoretical ex-right price, because the examiner in a lot of scenario, they do ask you to calculate the theoretical ex-right price. So how exactly do we calculate the theoretical ex-right price? What exactly is it? Let me just guide you a bit. So the theoretical ex-right price is, theoretically speaking, what is going to be the share price of the company after the right issue is made. Now when I talk about the theoretical ex-right price, I'll give you an example. Let's say a company makes a right issue of 2 for 5 ordinary shares at $3. That means for every person who has got 5 shares in the company, they'll be getting 2 shares, and each share is at $3. The existing share price is $4. The existing share price is $4. So now what is actually going to happen is that, let's try to understand this. When we are going to be doing this calculation, what is going to happen? The theoretical ex-right price is calculated like this. You would say that you have got 5 shares as an investor, you have got 5 shares currently, and each share is worth $4. So resultingly this is going to be $20. Then you have got 2 shares and each share is worth $3, so this is going to be $6. Resultingly you have got 7, you have got $26. So now what happens is that when you talk about the theoretical ex-right price, this is going to be 26 divided by 7. I repeat, this is going to be 26 divided by 7, so it turns out to be 3 point something. So the theoretical ex-right price is, theoretically speaking, what is going to be the share price if the company makes a right issue of the share. If the company makes a right issue of the share, what is going to be the share price? Now, so that's one calculation that you get. The second thing is that what are the other ways of raising the equity finance? The other ways of raising the equity finance is called private placement. How do you do the private placement? The private placement is simply, you want to raise finance, so what you do is that rather than going directly to the stock exchange, you could possibly contact different brokers, different investment bankers, and you could reach out to them and ask them to sell the shares. So usually what happens is that you pay lower commission, you incur lower cost, and you get your shares issued. Obviously, the shareholders, the existing shareholders, they have got preemptive rights. What is preemptive right? The preemptive right is the right to be offered the shares first before they are being offered to somebody else. So the existing shareholders, they have to forego their preemptive rights if the company has to offer the shares to somebody else. The third one of them is called the initial public offering. I might not be using the word initial public offering because use of the word public offering is appropriate rather than using initial public offering, because in some countries there is SP also, which is second public offering. There could be TP also, the third public offering, depending upon how many times the company goes to the public. So generally what happens is that you get listed, you sell your shares through the stock listing, through the stock exchange. So the IPO is the initial public offering. You get your company listed on the stock exchange, you sell your shares through the stock exchange. That's called the IPO all about. Now let's move a bit forward and let's discuss a bit further. So if you want to raise finance, I told you that these are the different ways of raising the finance through the equity. Now we talk about the debt. Now you see, the debt could be in the different forms. The debt could be in the different forms. The debt could be bank loan, it could be short term, lease is also a method of raising finance because you don't have to buy the asset, you take an asset on a lease. So when you take an asset on a lease, technically you have not invested that much amount, and at the same time you've got benefit of the asset, whichever the machine, land, property, etc., etc. Then the creditors is also one of the ways of financing your business in the short term, because when the creditors, they extend the money, that actually is helpful for the business as a whole. Then what happens is that you've got loan notes. You issue the loan notes. I bet what happens with respect to the loan notes is that There could be different type of loan notes. The loan notes are also termed as bonds. Amongst the different types of loan notes are, one of them is called straight bonds. One of them is called straight bonds. Some are called convertible bond. Some are called zero coupon bond. Some are called deep discount bonds. Then there are also called euro bonds. So there are multiple types of bonds, multiple type of loan notes that are actually in issue. Now when we talk about the concept of having the straight bonds, what exactly do you mean by having the straight bonds? Straight bonds are simple bonds, just like you got 4%, $100 5-year bond. So when you've got $100 5-year bond, so it's a straight bond where the 4% is your coupon rate, the $100 is your par value, the 5-year is your redemption period, so on and so forth. So that's actually going to be considered as a straight bond. Then you've got a convertible bond where the loan note holder has a choice that they can opt for conversion, they can opt for redemption. Zero coupon bond where the loan note is 0%. Usually what happens is that the zero coupon bond could be deep discount, or the zero coupon bond could be redeemable at large premium on the redemption, right? It could be large redemption premium also. Then you've got euro bonds. Euro bonds are the bonds which are actually issued in the foreign exchange, in the foreign currency. So like if you as an entity, what you do is that you issue the bonds in the foreign currency, that is going to be considered as your euro bonds. What is it going to be considered as? Euro bonds. So you are living in, let's say, UK, and in the UK you issue bonds denominated in Japanese yen or in Indian rupee or in any other currency. That's going to be considered as a euro bond. Now even when we talk about the bank loans, the bank loan could be short term, long term. There are further classifications, which is it could be secured, it could be unsecured. There could be different things with respect to the bank loans also. Now let me take you forward and let me just discuss about these things. So basically what happens is that this is how it is. You need to know that how can you go for raising finance, what's going to be the impact, what is going to cost high, what is going to cost low, and all this information is ultimately used when we are going to be discussing the weighted average cost of capital. Now there is this last area, which is basically Islamic finance. I am reviewing the Islamic finance as it is given in the ACCA syllabus. I'm not going to be talking about what the actual Islamic Sharia principles are. I'm just talking about the Islamic finance. Now generally what happens is that there is something which is called Sharia law. What is Sharia law? So the Islamic principles are actually termed as Sharia law. Now why don't we have any other sort of finance in our course? Why Islamic finance? Because globally there are generally two types of financial principles that exist. One of them is the conventional sources of finance, and one of them is the Islamic sources of finance. That's why nowadays every international body, they've got Islamic finance part and parcel of their course. The reason being, they want the students to know that what is the major difference between the Islamic and the conventional finance. So one major difference between Islamic and the conventional finance is the Sharia law. The Islamic finance is based on a Sharia principle, which is the Islamic law. And the Islamic law is Quran, the Islamic law is Ahadith, and the other analogy and etc. Now, what actually is the major difference between the Islamic principles and the conventional finance is that riba is prohibited in Islam. Riba, as we say in a normal conventional finance, interest. So the whole conventional finance is actually based upon the concept of interest. When we talk about conventional finance, the only thing that we talk about is the interest. We say for every single thing, just think about your opportunity being the interest foregone. But in the Islamic principles, the interest is prohibited. The third thing is that The currency is treated as a medium of exchange rather than a commodity. So what happens is that when you go for a conventional bank, the conventional bank would lend you money and they would ask additional money in return. But when you would go to Islamic bank, they would never lend you money. They would ask you, why do you need money? You would say, I need money to buy this, to buy that, to buy this, etc. So the Islamic banks, what they would do is that they would buy you an asset. They can buy you an asset and they would sell an asset to you, but they would never lend you the money if it's a proper Islamic bank. Now, furthermore, what actually happens is that why? Because they don't treat the money as a commodity. Like the conventional bank, what they are doing is they are giving you money, they are taking money back. So giving you $100, they are taking $103 back. So that means they're selling and they're buying the money. That's how it actually happens. So now what happens is that the Islamic bank, they treat the currency as a medium of exchange, not a commodity. Furthermore, the final thing is that when you would go for a conventional bank, you say that I'm investing in a casino, I'm investing in a hub, in a bar, drinks bar, wine bar. You say that I'm investing in XYZ business, I'm investing in the pig farming business, etc. The conventional bank wouldn't be bothered about it. They would obviously consider the industry specific risk, but they're least concerned about if you are going to be offering wine, if you're going to be offering some high quality alcohol drinks, it is not concerned about it. But when it comes to the Islamic finance, there are prohibitions in Islam about few things, like the alcohol is highly prohibited, casinos are prohibited, these insurance sector is prohibited. There are multiple prohibitions in Islam. The consumption, the trading, the dealing of pigs is prohibited. The pork is not allowed in Islam. Pork meat trading is not allowed in Islam. There are certain limitations, there are certain prohibitions. So as a Islamic finance, what happens is that you cannot even lend your money, you cannot even invest your money, you cannot even give your money to those businesses which are prohibited in Islam. That's also another major difference between the conventional and the Islamic finance. Now, what happens is that there are different type of Islamic financial product. And what are those different types of products? One of them is called Murabaha. Murabaha is trade credit. It's just like trade credit. One of them is Mudaraba. It's just like obtaining equity finance. One of them is Musharaka. It's just like entering into a partnership. One of them is Ijara. It's just like entering into a lease agreement. And last is basically Sukuk. You could say they are Islamic bonds, you could just say. Now, let me just guide you each one of them one by one, that what exactly are they. So when you talk about Murabaha, it's a method which is used by Islamic banks to lend money. Like you want to go to Islamic bank, you say, I want to buy this car. They would say, okay, we are buying this car for $100,000 and we are giving it to you for $110,000. And you need to pay us in this many number of years and etc. Now, as an Islamic bank, you cannot increase the amount if the timing of the payment changes. But the conventional bank, that changes the amount. As an Islamic bank, you cannot charge penalty if the amount is not paid on time. Because the price is fixed at the time of selling and that price is going to be the amount that you would recover irrespective of whether you recover in 1 year or 6 year or 10 year or whatsoever. Mudarba is equity finance where usually one person invests. Mudarba is usually equity finance where usually one person invests, the other manages. It's just like mutual funds. Then you've got Musharaka. Musharaka is partnership where all the partners have to invest. Ijara is whatever lease agreements they are Ijara. Now just keep in mind that whatever mode of Islamic finance you are using, you just have to make sure one thing, which is the Islamic principles are going to prevail, which is no prohibited business, which is going to be no interest involved, which is going to be don't treat the commodity, the currency as a commodity, but rather a medium of exchange. So these are the things that are for sure gonna prevail, right? Now there is this sukuk. Now what is this generally sukuk? Sukuk are called as bonds, but they actually give you an ownership of an asset. They're asset-based securities. Like maybe possible, you're constructing a huge building. You need money for that. Now maybe you're constructing 10 floors and you are constructing 100 apartments in that building. And you've taken money from 100 people by issuing them sukuks. Now what happens is that those 100 people, they have got ownership of this apartment. But obviously there's an arrangement that we are going to buy back this sukuk from you. We are going to pay the rental income from this to you after deducting our share of investment and etc. So basically what's the difference between sukuk and mudaraba? In mudaraba, one person gives the money, the other person manages it. In sukuk, one person gives the money, but the money is being given for a specific asset. It's not for a general business. So sukuk are always asset backed. They're backed by an asset. They are based on certain asset. So this is what the sukuk are. This is how sukuks operate. So generally, from the perspective of the Islamic finance, this is how you might actually be tested the theory, the theoretical portion, the impacts on the ratios, and this is how things are gonna operate. Okay, now we move on to the next area, which is called the cost of capital. So the cost of capital is also termed as weighted average cost of capital, and the short form of it is WACC. Now if I talk about the weighted average cost of capital, you know how the WACC is calculated. The WACC is calculated like this. You say KE multiply by E divided by E plus D plus KD 1 minus T, plus what happens is it's the KD 1 minus T multiply by D upon E plus D. And when we calculate this weighted average cost of capital, so what happens is that the KE is your cost of equity. The E is your market value of equity. The KD is your cost of debt. The KD 1 minus T is your after tax cost of debt. Then you have got D, which is the market value of debt. So what happens is that when we calculate the weighted average cost of capital, this WACC actually tells you the average return that the providers of finance are demanding from you. I repeat, the WACC actually tells you the average return the providers of finance are demanding from you. So this WACC could be used as a discount rate for your projects. This WACC could be used as a benchmark rate, that okay, this is the minimum return that we will have to achieve. So things like that, this is something the WACC could actually act as. Now when we talk about the calculation of this different type of cost, the cost of equity and so and so. So first of all, I'm going to talk about the cost of equity. The cost of equity you could calculate using two models. One of them is called capital asset pricing model. The other one of them is called dividend valuation model. Under the capital asset pricing model, you have the KE is equivalent to risk-free rate of return plus equity beta into RM minus RF. Now what exactly is this all about? So when you talk about the RF, it is called risk-free rate of return. The RM is going to be the market rate. RM minus RF is going to be market risk premium, and the BE is called equity beta. So basically when we talk about the capital asset pricing model, it's a method, it's a good method of calculating the equity, cost of equity, because it actually incorporates the risk of the capital markets. Then you have got the dividend valuation model. What happens under the dividend valuation model is that When we talk about the dividend valuation model, it's actually the model for the valuation of the shares. But what we do is that we use this model to to establish the cost of equity. How do we calculate D naught 1 plus G divided by P naught plus G? And when we talk about the components of this, we say that D naught is X dividend share price. We know G is the dividend growth rate. We know, it's the X dividend. We know P naught is D naught is current dividend. This is X dividend share price. So you could calculate the cost of equity using either of these formulas. Now, when we talk about the dividend valuation model, there is an important aspect with respect to dividend valuation model, which is the computation of dividend growth rate. I repeat, which is the computation of dividend growth rate. Now, when I talk about the computation of dividend growth rate, the dividend growth rates could be calculated using two models. What are the two methods of doing this? One of them is called the historical growth model, and the other one of them is called Gordon growth model. Now, what's the historical growth rate? The historical growth rate could be calculated like this. You could say latest dividend divided by earliest dividend power 1 upon n minus 1. So if you want to calculate the historical this growth rate, this is how you could do it. Let's say, for example, you've got the latest dividend per share as 1.5, you had the earliest dividend as 0.8, you got to do the power. Let's say the dividend has grown by 4 times minus 1, so you would ultimately get the dividend growth rate. If we talk about the Gordon growth model, the Gordon growth model formula is G is equivalent to BRE. Now, what exactly do you mean by G is equivalent to BRE? When we talk about B is called retention ratio. Now, what do you mean by retention ratio? It's the proportion of the profits that are retained in the business. I repeat, retention ratio actually means the proportion of the profits that have been retained in the business, that is going to be called the retention ratio. And RE is the rate of return. RE is the rate of return. So rate of return, for you to calculate this, could be your KE, could be your return on asset, could be on return on equity, could be any other return that could actually be given to you in the examination in the question. Now when we talk about the retention ratio, so let's say you've got a profit after tax of 1000, let's say you've got dividend of 300, so you've got 700 as your retained earning. And when you have got 700 as your retained earning, so 700 divided by 1000, 70% is going to be considered as your retention ratio. I bet 70% is going to be considered as your retention ratio. So what's the retention ratio? Retention ratio actually refers to the percentage of the profits that have been retained that is going to be considered as retention ratio. Now let's move a bit forward, let's discuss a bit further. So basically what happens is that when we talk about the dividend valuation model, this is how things are actually going to be. Now one more important thing before I move on to the cost of debt and the other aspects of the WACC. So I would actually say that at times what happens is that the examiner makes you calculate project a specific cost of equity. I repeat, at times what happens is that the examiner makes you calculate the project a specific cost of equity. What is this project a specific cost of equity? So let's say when you undertake a project where your business risk or your financial risk changes. if because of a new project your business risk or your financial risk changes. So in case if the business risk or the financial risk changes, so what happens is that your existing WACC cannot be used as a discount rate. I repeat, your existing WACC cannot be used as a discount rate. You will have to use project specific cost of equity. Now, before I go on to project specific cost of equity revision, I need to tell you that there are betas. There are different types of betas. What are those different type of beta? One of them is called debt beta, one of them is called asset beta, and the third one of them is called equity beta. Now what exactly are the difference between them? Let's talk about them. When we talk about the debt beta actually is a measure of the financial risk. The asset beta is a measure of business risk. The equity beta is basically a measure of business risk plus the financial risk. The equity beta is also a measure of business risk plus financial risk, and this also reflects the systematic risk. Now let's move a bit forward and let's discuss further. So generally they are represented with this debt beta, asset beta, and then equity beta. Now if I talk about these, that what are these, so you now know that what is the reflection of business risk, what is the reflection of financial risk, and what is the reflection of both of them. So how do we calculate the project specific cost of equity? So there are certain steps that you have to follow. What are those certain steps that you have to follow? The number one step is that you got to identify a proxy company. Then what happens is that you have to calculate proxy equity beta. The third thing is you have to ungear or you have to de-gear the proxy equity beta. The fourth one of them is you have to re-gear the asset beta at the proposed gearing levels for the project. And the step number 5 is that calculate the cost of equity. Now if I talk about all this, so the first thing is that you got to identify proxy company, then you have to calculate proxy equity beta, and then de-gear. De-gear is actually that you have to convert the equity beta to asset beta. De-gear is you have to convert equity beta to asset beta. And when we talk about the re-gear, re-gear is basically converting back the asset beta to equity beta. So basically you identify proxy company, you establish its equity beta, de-gear it, and after de-gearing you get the business risk. Now you re-gear it at the proposed gearing level. And we have been given this formula in the examination also, which is asset beta is equivalent to equity beta multiplied by E upon E plus D 1 minus T. There is other portion of the formula also given, which is about the debt beta, but that has to be ignored because debt beta is usually assumed to be 0. Now at times you have to rearrange the formula also, where you have to make equity beta as a subject. So it's actually going to be asset beta into E plus D 1 minus T divided by E. Now that's how the equity beta is going to be. Now let's move a bit forward and let's discuss further. So I've talked about the computation, the determination of risk adjusted cost of equity also. And when do we calculate risk adjusted cost of equity? when we are undertaking a project where either the business risk or the financial risk changes. If both changes, then again also, but if either of them changes, you have to go for the alternate. Now let's move a bit forward, let's talk a bit further. So now the next aspect of this specific scenario is that you need to understand that when we talk about the cost of debt, the cost of debt always has to be KD1 minus T. Why? Because the interest is a deductible expense. So whenever we are going to be talking about the cost of debt, it has to be after tax. It has to be after tax. Unless and until taxation is ignored. Unless and until taxation is ignored. So now basically the debts are of three categories majorly. And we have got three different type of ways of calculating it. You have got a debt which is bank loan. Irredeemable debt. And then you have got redeemable loan notes. Now when you talk about all this, what actually happens is that for the debt which is basically the bank loan, all that you have to do is that you have to simply say interest percentage multiply 1 minus T. So like if you have got a 10% loan, 10% multiplied by if you have got 30% interest, so net 7% is KD 1 minus T for the bank loan. For the irredeemable debt, all that you have to do is that you have to say after tax interest divided by market value. So like if you have got a 10% 100,000 loan, the tax rate is 40% and the market value of the bond is, let's say, 70,000. So what are you going to do? You're going to say 10% into 100,000 into 0.6 divide by 70,000. So you will end up getting what? 10% into 100,000 into 0.6. So that actually gives you 6,000. 6,000 divided by 70,000 is going to be your cost. For the redeemable loan notes, what do you need to do? You need to calculate IRR. For the IRR, the important thing is that if it is time period 0, for time period 0, the market value of loan note has to be shown as an outflow. Time period 1 till 5 or whatever that is, show after tax interest. For the final period, show redemption value. Show redemption value. So you've got bank loan, you've got irredeemable loan note, you've got redeemable loan notes. That's how things actually go about. Now, let's move a bit forward and let's discuss further the other aspects, which is you have got at times the preference shares also. So when we talk about the concept of preference shares, so the preference shares is basically the K preference shares. What is it? It's actually K preference shares, the cost of preference shares. All that you have to do is that it has to be the preference dividend divided by market value. I repeat, it has to be the preference dividend divided by market value. That's how you actually establish. Now, final conclusion, that how do we calculate the WACC? So for the WACC, I would suggest do it like this. You could actually make a table where you would name the source. You would write down its cost in terms of percentage. You would write down its value. You would write down its cost in terms of dollars. Now when you are actually going to do it, what is going to happen? What is going to happen is that you would say that, let's say we have got equity, we have got bank loan, we've got loan notes. Let's say if it is 15%, it is 8%, it is 11%, it is 10%, let's say. So what are you going to do? You're going to make a table like this. Instead of writing down the whole long equation, this is a shortcut. 15% into 100 gives you 15,000. 8% into 200,000 gives you 16,000. 11% into 300,000 gives you 33,000. What is it going to give you? 33,000. 10% into 50,000 gives you 5,000. So hence, resultingly, what's going to happen is that 15 plus 16 plus 33 plus 5, whatever this amount, this amount. This is, let's say, A, this is, let's say, B. So your WACC is going to be B divided by A. You will end up getting the WACC as a percentage. So basically, what have I done? I've actually taken you through the computational aspects of the cost of capital also. Okay, now we move on to discuss about another aspect, and that's the business valuations. So let me just take you people through the business valuation. That when we talk about the business valuations, it's not just about valuing the business. There is another aspect which is valuing of the bonds also, which is also part and parcel of the syllabus. So let me just take you people through the business valuations. There are majorly 3 different types of valuation techniques. And what are those 3 different type of valuation technique? One of them is called asset-based valuation. The other one of them is called income-based valuation. And the third one of them is called the cash flow based valuations. What is it? It's actually termed as cash flow based valuations. Now, when we talk about all of these, so what is actually going to happen is that the asset-based valuation, I repeat, with respect to the asset-based valuation, we value the business on the basis of net assets. We value the business on the basis of net assets. And you know what a net assets is? It's simply asset less the liability. You end up getting the net assets. So other way around, you could also say that the net assets are actually your equity. I repeat, the net assets are actually your equity. Now, one thing is the asset-based valuation, that's one thing. Then you've got income-based valuation, where you have got PE ratio-based valuation, where you have got earnings yield valuation. So these are the 2 different type of valuation. And then the third is cash flow based valuation, where you have got dividend valuation model, and you've got the future cash flows also. So there could be different type of valuations. Now, let me just take you people through that what exactly is going to happen with all of this. Now, when I talk about the asset-based valuation, what happens with the asset-based valuation? There could be different type of asset-based valuation. There could be an asset-based valuation with only net book value, means the book values of the assets, the book value of the liabilities. There could be net realizable value. And there could be net replacement value also. Now, what actually happens is that you can have net book value, you can have net realizable value, you can have net replacement value. The net book value is simply the book value of assets, the book value of liabilities. That's what the net book value is. When we talk about the net realizable value, it's the value at which the asset could be sold. I repeat, it's the value at which the asset could be sold. It's the value at which the liability could be settled. That's what the net realizable value is going to be. And then we have got the net replacement value, which is if you want to buy similar type of assets, what value are you going to be buying at? Generally, the examiner, what he does is that he tests all of these things in tandem. He tests all of these things together. That's what he does as an examiner. So you don't have like applying a single technique. You're probably going to be applying all three different type of techniques. So all that you have to do is that you got to keep in mind that the value is on the basis of net assets, and then now you can have fair value of the net assets and etc., things like that. So one of them is basically the asset-based valuation. The other one of them is an income-based valuation model. So when we go about the P ratio based valuation model, so there are certain steps that you have to follow. The number one of them is you have to identify a proxy company. Now what exactly do you mean by the proxy company? The proxy company actually means a company which is from the perspective of a proxy company is one of those companies that is similar to the company you are valuing. So you identify the proxy company, you calculate the proxy PE ratio. The P ratio, I hope that you people know, the P ratio is share price divided by EPS. Now the third step that you do is that you adjust. What you do is that you adjust proxy PE, and the fourth step, I repeat, the fourth step is gonna be you calculate share price using adjusted P ratio. You calculate the share price using adjusted PE ratio. So what happens is that you identify the proxy company, you calculate the proxy PE ratio, then you adjust the proxy PE, and then you calculate the share price using the adjusted PE ratio. Now, let me guide you people a bit. Let me just see that what exactly is it mean. So generally what happens is that the adjustment to the proxy company PE ratio is just to make sure that it is reflecting the private company things. Like for example, the industry PE ratio is 10 times, and you might say that private companies should be valued at 7 times. So simply you are going to rearrange the formula, and the rearranged formula is going to be share price is equivalent to the rearranged formula is going to be share price is equivalent to PE multiplied by EPS. Similarly, at times what happens is that the examiner could give you earnings yield also. Always remember, the earnings yield is opposite of P ratio. The earnings yield is simply when you have got PE as a share price divided by EPS, the earnings yield is EPS divided by share price. So if you want to calculate the share price using earnings yield, how are you going to do? You're going to say earnings yield divided by, you are simply going to say EPS divided by earnings yield. So that's how you calculate the earnings yield, and the rest everything is same. You identify a company in the market, you establish their earnings yield, you adjust their earning yield, and then you accordingly value the company. The last step is basically valuation of the company using the cash flow based valuation. Always remember, the value of a company is present value of future cash flow. It's the present value of future cash flows. One of the scenarios that's examined a lot with you people is that maybe possible the dividend valuation model, you know this thing. So when we have the dividend valuation model, the P naught, which is the current ex dividend share price, is established like this: D naught (1 plus G) divided by KE minus G. Now if I talk about this whole, So I'm actually going to guide you that how exactly you should value. So if let's say for example, if you are going to get constant dividend till infinity, all that you have to do is that you have to say D naught divided by KE. This is what the formula is gonna be. Number 2, if you are gonna say dividends growing at constant rate till infinity, so you are gonna use this D naught 1 plus G divided by KE minus G. The third one of them is gonna be, the examiner could actually give you things like this. He could actually say that the dividends could actually be suggested like this. Maybe year 1 dividend could be given, year 2 could be given, and he might say year 3 till infinity the dividend are gonna be X, Y, Z. So how are you gonna calculate? Let's try to do. Let's say your cost of equity is 10%, and this dividend is expected to be $5. This dividend is expected to be $7, and this dividend is expected to be growing by $7, growing by 3%. So how would you calculate the value of this company? Let's just try to see this. You would say $5 multiply 1.1 power minus 1. Then you would have $7 multiply 1.1 power minus 2. And then what happens is that $7 multiply 1.03 divided by KE minus G. What's the KE? It's 10% minus 3%. And this is basically, since it's 3 till infinity, so when you're going to discount it, it will come back to your 2 level. So now you have to do it multiply 1.1 power minus 2. So hence, whatever the values are going to be, you're going to add up all of them, you will end up getting the value of the company. What are you going to end up getting? You're going to end up getting the value of the company. So usually what happens is that dividend valuation models is one of the valuation model which is used, and I've actually given you different type of situations where the cash flows are to be used and the values are established. Now, at times the examiner would actually ask you to value the bond. So again, value of a bond is present value of future cash flow discounted using market rate of interest. How would you calculate all of this? Present value of future cash flow discounted using market rate of interest. So like if it's at 10%, 10,000 3-year bond, the market rate is 15%. What are you going to do? You're going to say here, you're going to say cash flow, you're going to say discount factor, you're going to say present value. So this is how it is gonna be. I bet this is how it is actually gonna be. So if you are being asked to calculate value of a bond, that's how you do it. Now at times what happens is that As an entity, you are also asked to value, as a student, you are also asked to value a convertible bond. So everything remains the same except for the last year. You would see which is more attractive for the user. Will he get more money in terms of conversion, or will he get more money in terms of redemption? So if he gets more money in terms of conversion, you put the conversion value. If he gets more money in terms of redemption, you put the redemption value. Whichever is going to yield you more money, you're going to put that. Conversion or redemption. So when we talk about the convertible bond, this is how things actually go. So basically we have talked about the valuation also. And these are the major areas: the investment appraisal, the sources of finance, the cost of capital, the business valuation, and there is this final area, working capital management also, which I'm also gonna add up now. So guys, thank you very much for your time. I hope you would have enjoyed the revision, and this is the revision of all the major areas of the syllabus, and hopefully inshallah this is going to benefit you a lot. Take care and see you soon inshallah for the upcoming courses. Thank you.